Right now in Australia, there's a savings account paying close to 6%, and then there's another one from one of the big four banks that can leave you with almost the same return, but without making you jump through nearly as many hoops. The funny thing is, most people looking for a savings account in 2026 will see the biggest number in an ad and assume that's automatically the best option. But that's not always how it works. Sometimes the account with the flashiest rate ends up paying you less simply because the conditions are so easy to miss. So in this video, I'm going to break it all down in plain English, explain why that happens, and help you figure out which account actually makes the most sense for your money. The reason this matters a lot more now than it did a couple of years ago comes down to what the Reserve Bank has been doing with interest rates. After a run of increases earlier on, the RBA has held the cash rate at 4.35% at its latest meeting, and whenever the RBA moves, banks usually adjust their savings rates as well. The good news is that savers are finally seeing some genuinely decent returns again, with a few accounts now paying close to 6%, which is something we really haven't seen consistently for quite a while. But there's a catch. The gap between a great savings account and an average one has become much bigger, so picking the wrong account isn't just a small mistake anymore. It can literally cost you hundreds of dollars a year without you even realizing it. Before we jump into comparing the different banks, it's worth understanding what actually separates a good savings account from one that just looks good in the advertisement. The interest rate is usually the first thing everyone notices, but it's almost never the full story. Most banks split that rate into a small base rate and a much bigger bonus rate, and you only get that bonus if you tick all of their monthly boxes. That could mean depositing a certain amount every month, making sure your balance grows by the end of the month, or using a linked debit card a set number of times. Miss just one of those conditions and your interest can drop from something close to 6% to almost nothing for that entire month, which completely defeats the purpose. On top of that, some banks also take away your bonus rate if you make even a single withdrawal, even if it's for a genuine emergency. And while monthly account fees are pretty rare these days, it's still worth checking for little charges like paper statement fees or branch transaction fees because they can quietly eat away at your returns. Alright mate, now let's get into the accounts themselves because this is where things start to get interesting. Sitting right at the top of the market at the moment is Rabobank. Their high-interest savings account is offering an introductory rate of 5.9% for the first 4 months on balances up to $250,000, before it drops back to a standard variable rate of 4%. Now that headline rate is definitely impressive, but you've just got to remember it's only temporary. If you're opening the account purely for that 6% figure, make sure you've got a plan for what you'll do once those 4 months are up. If you'd rather keep things simple and not worry about ticking boxes every month, then AmpBank's GeoSave account is definitely worth a look. It's currently paying 5.1% ongoing on balances up to $500,000, and the best part is there are no bonus conditions, no age limits, and no minimum balance requirements. You just put your money in and earn the advertised rate. For a lot of people, that simplicity alone is worth giving up a tiny bit of extra interest. Now, if you're between 18 and 40 years old, Westpac's Life Savings account becomes a really strong option. It's currently paying 5.75% on balances up to $150,000, but you'll need to meet the monthly conditions, like growing your balance and completing the required transactions. If you're already doing those things anyway, it can be one of the better paying accounts around. Then there's ING's Savings Maximiser, which has been a favorite with Australians for years. It still offers a competitive bonus rate, but you do have to stay on top of the rules. That means paying money into your linked ING account, making the required card purchases each month, and growing your balance. Miss any one of those conditions, even by accident, and the interest drops back to a much lower base rate, so it's definitely an account where you need to stay organized. And finally, there's Macquarie's savings account. It doesn't usually sit right at the top of the interest rate table, but it's one of the easiest accounts to live with because there are no monthly hoops to jump through. No minimum deposits, no card purchases, and no balance growth requirements. You simply park your money there and earn the variable rate, which makes it a great low-maintenance option if you don't want to think about your savings account every month. If you just want the quick version of everything we've talked about so far, here's a simple comparison on one screen. It's probably worth pausing the video for a few seconds if you're thinking about opening a new savings account, because it makes the differences a lot easier to see. One thing you'll probably notice straight away is there's a bit of a pattern here. The accounts paying the very highest rates usually ask the most from you, whether that's making card purchases, growing your balance every month, or meeting a few other conditions. On the other hand, the accounts with fewer or no conditions tend to pay a slightly lower rate, but they're also much harder to get wrong. Neither option is automatically better. It really comes down to the kind of person you are. If you're happy keeping track of a few monthly requirements, then chasing the higher rate might be worth it. But if you're someone who'd rather set it up once and not think about it again, taking a slightly lower rate for complete peace of mind can actually be the smarter choice. Now, let's put some real numbers behind all of this because percentages don't always mean much until you see them in dollars. Say you've got $10,000 sitting in an account paying around 5.1% like AMP's GO Save. Over a year, that's roughly $510 in interest. If you've got $50,000, you're looking at around $2,550 a year. And with $100,000, that grows to roughly $5,100 annually, simply for keeping your money in the right savings account instead of leaving it in an everyday transaction account earning next to nothing. Now compare that with an account paying closer to 5.75%, assuming you meet all the bonus conditions. Those same balances would earn roughly $575, $2,875, and $5,750 over a year. On a $100,000 balance, that's more than $600 in extra interest. And that's exactly why it's worth spending a few minutes reading the conditions before opening an account. Because a small difference in the interest rate can turn into a pretty decent amount of money over the course of a year. Now, the truth is there isn't one savings account that's perfect for everyone. The best option really depends on how you manage your money and what you're actually saving for. If you're a student, for example, your income might be a bit inconsistent from month to month. So an account with no minimum deposits and no penalties for missing a quiet month, like AMP GO Save or Macquarie's savings account, is probably going to make life a lot easier than trying to chase a bonus rate you don't always qualify for. If you're managing a household or saving as a family, then accounts like ANZ Plus or ING Savings Maximiser can work really well because you're probably adding money to your savings regularly anyway. In that situation, meeting the monthly growth requirement often happens naturally, so earning the higher bonus rate becomes a lot more realistic. Now, if you're building an emergency fund, I'd actually look at things a little differently. The whole point of an emergency fund is being able to access your money whenever you need it. You don't want to be worrying about losing a month's worth of bonus interest just because you had to pay for an unexpected car repair or a medical bill. That's why no conditions accounts usually make the most sense for emergency savings, even if the interest rate is slightly lower. On the other hand, if you're saving for something long-term like a home deposit, then putting in a bit of extra effort can definitely pay off. If you're eligible for an account like Westpac Life and you're confident you'll meet the monthly conditions, that higher bonus rate can add up to hundreds of extra dollars over a few years. Once you start compounding those extra earnings, the difference becomes much more meaningful than it looks at first glance. There are a few mistakes that people make over and over again with savings accounts, and the good news is they're all pretty easy to avoid once you know what to look for. Probably the biggest one is chasing a really high introductory rate without thinking about what happens when that promotion ends. A bank might offer close to 6% for the first 4 months, but once that period is over, the rate can quietly fall back to around 4% or even lower. If you're not keeping an eye on it, you could spend months earning a lot less than you expected. Another really common mistake is making a withdrawal without realizing it wipes out your bonus interest for the entire month, not just on the amount you took out. That's something that catches a lot of people by surprise, especially when they need to dip into their savings for an unexpected expense. People also forget to check whether they're actually meeting all of the monthly bonus conditions. Maybe they missed the required deposit, didn't grow their balance enough, or forgot a couple of card purchases. It only takes one missed condition for your interest rate to drop dramatically, and here's one that doesn't get talked about enough. People open a savings account, set it up once, and then never look at it again. The savings market changes all the time. Banks regularly increase or decrease their rates, and the account that was one of the best options a year ago might not even be close to the top today. Spending 5 minutes every few months to check whether you're still getting a competitive rate can make a bigger difference than most people realize. So if I had to sum it all up, it really comes down to how hands-on you want to be. If you just want something simple with a solid interest rate and no monthly conditions to worry about, AMP GO Save is still one of the strongest options out there. If you're happy to meet a few monthly requirements and you're in the eligible age bracket, then Westpac Life can reward you with one of the better ongoing rates available. And if your goal is simply to grab the highest rate you can right now, and you're happy to move your money again in a few months, then Rabobank's introductory offer is hard to ignore, as long as you've already got a plan for what you'll do once that promotional rate expires. At the end of the day, don't think of choosing a savings account as a one-time decision. Interest rates change, banks update their offers, and what works best today might not be the best option 6 months from now. Checking in every few months can help make sure your money keeps working as hard as possible for you. So mate, I'm curious, which bank are you using for your savings at the moment? Let me know down in the comments. I'd love to hear what you're using and whether you've had a good experience with it. And if you found this video helpful, don't forget to subscribe for more straightforward Australian personal finance tips.